Hey there folks, this is Patrick King with Prana Wealth. On this channel we help you build your wealth faster so that you can make work optional sooner. So if you're new here, please consider subscribing and don't forget to sign up for our newsletter at pranawealth.com/newsletter. As you're acutely aware, we live in extraordinary times, especially from the standpoint of financial markets. Rather than diving into one of our normal financial planning topics, this week I instead wanted to bring you a current market situation report. If you find this video helpful, please like this video below and leave me a comment. I may eventually begin live streaming this content in the future if you find it informative. Depending upon the source, today's markets are either the greatest ever and will never ever go down again, or they are poised on the brink of a biblical apocalypse. But what do the numbers have to tell us? And more importantly, what can we do to prepare ourselves for these possible outcomes? Before we get into the details, let me be clear. There is no perfect metric or indicator that will tell us what will happen next. Markets are among the most complicated of human inventions ever conceived. There's nothing linear about them. There are thousands of variables that factor into their movement, including second and third order variables such as financial derivatives. With that said, let's review a few key market indicators to gain some idea of where we are and where we could go from here. All right, folks, here we are with our first indicator. This is the market valuation divided by US GDP, also known as the Buffett Indicator. Now, Warren Buffett likes this as his, go-to indicator for how valued under or over the markets are at any given point, acknowledging that there is no perfect indicator for these things. But what it is the value of the stock market divided by the US GDP, gross domestic product. The GDP is essentially the value of all the goods and services that we produce here in the United States. So what we produce is divided into the value of the market. So as you can see here, we're at currentmarketvaluation.com. It's a great go-to place for this kind of information. So pop on over there if you want to keep up with this on a day-to-day basis. But what we see is over time, here we are back in the tech bubble. You can see my cursor. It was way overvalued. These red lines this is 2 standard deviations above average. Yellow line is 1 standard deviation. For those of you who are not statistically inclined, 2 standard deviations is supposed to occur about less than 2% of the time. So where are we today? We're way out here. Way out here. Markets, according to the Buffett Indicator, are more overvalued than they were in the tech bubble, which is not good if you want to just look at this one indicator. So what it is also telling us is that based on the ratio right now, which is 233%, 87% higher than the long-term trend line, we could have a drop of 10%, a correction, a legit correction in the markets today, and we would still be more overvalued than the market was at the peak of the tech bubble. So this is not telling us that we have a whole lot of room on the upside. That being said, those who would argue against that would say that GDP is a lagging indicator, and that after the pandemic or I guess now that the pandemic is receding, I guess it's not gone at this point, we would expect GDP to grow, which is your denominator, and then would therefore bring this indicator down some. But as I said, it's still way over 2 standard deviations above the trend line. Yeah, overvalued based on this one. So again, GDP is lagging, so we expect that to grow now that we're opening things back up. But again, still overvalued by this measure. The next indicator that we want to look at is the value relative to interest rates. So again, this is on currentmarketvaluation.com. I love this site. Go pop over there and check it out. So what we're looking at here is the value of the stock market. Well, this is the S&P 500. So the 500 biggest publicly traded companies in the US divided by current interest rates. So what they're looking at now is the 10-year Treasury interest rate as the benchmark here. So what you can see, in this purple line is the indicator over time. And out here in 2020, we're in this, between plus and minus 1 standard deviations, which I guess would be normally valued. As you can see, we're above the long-term trend line, but we're not so far above that it would be alarming. So according to this indicator, that we are fairly valued in the markets right now. And that makes sense because when you have low interest rates like we have right now, it means that investors are continuously forced into riskier assets in order to get higher returns. And that makes sense. They're not getting a whole lot in their checking accounts. They're not getting a whole ton of yield in safe bonds or short-term bonds. So if you're a retiree and you're like, hey, look, I need to get more returns to ensure that my portfolio beats inflation, I need to go take more risk. And then people pile into the stock market, and here we are. These low interest rates right now, so you can see these kind of non-bolded lines here. So the red one is interest rates. You can see they're extremely low, greater than 1 standard deviation lower than historical norms. Of course, that's going to pull down on these way high valuations. So, the blue line here is your S&P 500. It is greater than 2 standard deviations above its historical norm. So you've got these two opposing forces right now that are taking this indicator into that fairly valued territory. One reason that the interest rates are so low right now is because the United States is the greatest debtor of all time in the history of mankind at this point. So having those low interest rates allows Uncle Sam to roll the debt service over at a low interest rate. So your drunk Uncle Sam has been running up his credit cards, and he's making sure that he gets the 0 interest rate promotion instead of 18% like most of us have or higher on our revolving debt. If that interest rate goes up, Uncle Sam's going to have a hard time making the monthly payments on that credit card, essentially. And it could bring some sort of question around the creditworthiness of Uncle Sam at that point, which is why he is suppressing those interest rates. Just something to think about there. All right, that's our second indicator. Third indicator that I want to bring up today is margin debt. So this is another great website that I love. This is Advisor Perspectives. They update this. Now, FINRA releases the actual margin data on a regular basis, a monthly basis. They lag a couple of months, but Advisor Perspectives always has some nice, beautiful graphs here, as we can see, that I love. So if you look at margin debt, so what is margin debt? Margin is the amount of money that people have borrowed in order to invest, right? So let's say you've got $100 to invest, you put it all in the stock market, the brokerage firm or Robinhood or whoever it is says, hey, we like your credit, you're good for $20 of margin. That way you could put $120 into the market and let it grow. Of course, you'd have to pay back that margin loan at some point, but of course, today the markets go up. Always, ever, never, ever do they go down. So why wouldn't you borrow money and put it in the market? Okay, so margin debt levels are a great indicator of the amount of speculation in the stock market right now. So speculation tends to correlate with frothy, bubbly activity, right? So let's take a look at what we got here. This goes all the way back to 97. You can see 97, the tech bubble. People had gone in on margin to buy stocks back then. Of course, it was a little bit different environment. Doing all this trading wasn't necessarily as easy or automated as we have today. Let's see, margin debt. Back here again, 2007, another peak before the crash. A lot of margin debt. But after the great financial crisis, this is, I guess the trough was back in February of 2009. We're trending up, of course. It peaked before coronavirus. We had a drop, as you would expect. Once we've got a risk-off situation, people are going to start paying that money back, or they're going to get margin called which means that the brokerage firm says, hey, we're not quite sure that you've got enough collateral. We're going to need you to pay that back right now. But here's what's happened since stimmy checks started coming out. As you can see, margin debt has exploded, and we're at the highest point, I guess, well, since this graph is it goes back to 97, and just look at where we are. And this is adjusted to present day dollars. So this isn't one of those things where, well, inflation means that it's skewed the graph. And this is adjusted for inflation. We've got essentially the most speculation that we've had in the markets for a long, long, long time, maybe even ever. And look at the acceleration that we see during the pandemic. And this makes total sense, because if you think about Wall Street bets and meme stocks and cryptos and NFTs, it's we're in a speculative environment right now. This harkens back to the day trader era, pre-tech bubble. I was pretty young back then, but I was old enough to kind of remember everything that was going on. But this is a big red flag, folks. Essentially, if you've got this amount of debt that's tied to equities, basically the stock market, taking out loans to put into this market, it's a big red flag, right? So we're our first, the Buffett Indicator, here we are again, huge red flag, maybe highest ever, at least highest since the 90s. We're looking at this saying, "Ooh, this is not good." Stocks don't have a lot of room to move up from there. You look at this second indicator, interest rates. All right, okay, maybe we're close to the historical average because interest rates are low. Of course, we expect a little bit more investments in stocks. This one's another red flag, folks. A huge amount of margin, and then just the acceleration that it's happened since the pandemic. That's our third indicator that we want to look at in our sit rep today. And then let's move on to money supply. So this is the M1 money stock. This is also publicly available stuff. This is the St. Louis Fed publishes this and continuously updates it. What M1 money stock is essentially all of the cash, traveler's checks, near cash instruments that are out there that you can access quickly, easily. Liquidity essentially is what the M1 is. And look at this. Since I guess this goes back to, where does it go back to? 1975. We're just kind of increasing the money supply. Oh, hey, here's the financial crisis right here, 2007, 2000. All right, we're going to add a little liquidity. Remember back when the bailouts for the financial crisis in the order of billions seemed like just absolutely astronomical? Well, guess what, folks? Coronavirus, there's a big difference between billions and trillions, right? So we are looking at just explosion of money into the system. What's even more interesting about this is even though more money has been introduced into the system, the Fed still can't get it in there fast enough. They're trying to, right now, banks have to buy treasuries from the Treasury, and they essentially sell those to the Fed to get cash. And the Fed kind of forces them to do this. The Fed kind of points a gun at these commercial banks and says, you buy these treasuries and swap us out for cash. And that's how cash gets introduced to the system, because the Fed just can't legally put money into the system. Well, turns out that the banks, commercial banks these days are really balking at this because they don't want a ton of cash on their books. They'd rather have the treasuries because those count towards some of their collateral obligations. Some of these banking regulations that came with Dodd-Frank, these balance sheet shoring, wow, I sure did come up with a tongue twister there. These regulations that made sure that the bank's balance sheets were healthy means that they don't want to do a bunch of loans right now because they don't have the collateral required to back them up. So what they end up doing is going to what's called the overnight reverse repo facility, which means that the Fed says, hey, you sell us these treasuries and we'll give you cash. And the banks say, okay, you're forcing us to. But they can immediately the next night go back and say, no, here's your cash back. We want our treasuries again because we can collateralize some sort of like positive ROI instrument by holding these treasuries as collateral instead of, giving out consumer loans, which are a liability on their balance sheet. It's super complicated. I've had to really dig into it recently, but it's super interesting too. The point of all this is that the Fed can't get cash into the system fast enough right now. That's what's crazy. That brings us to our next indicator, which is the velocity of money. So the velocity of money, all right, you're looking at that M1 money stock that we just talked about, the total amount of cash that's out in the system. And the velocity is how frequently that cash turns over. So this is an interesting metric because as velocity goes up, economic activity goes up. So it's directly related to GDP. And the higher the money velocity, the more healthy the economy is. As you can see, this goes back to the 1959, right? You've got some increasing velocity, get some bumps along the way. Of course, it goes down in the financial crisis. We get a huge bailout, right? So dump a ton of money into the system, eventually it goes down until, bam, coronavirus. And it is just on the floor. I mean, the velocity, M1 velocity is passed out drunk in the gutter right now. So let's do this. Let's see, 2007. Go back 2007. So yeah, right before the financial crisis, money velocity has just cratered. So these two things, over history, have worked kind of in opposite manners. So dump a bunch of money in there, it's going to be harder to circulate the economy. That kind of makes sense in some regards. But again, excuse me, how did I hit that? But so you look at what we've got here, it's all right, okay, is it turning up at some point? We don't know. We expect GDP to grow as we come out of the coronavirus pandemic, lockdowns and all that stuff, closures. What to look for with money velocity is, instead of being inversely correlated with that money supply, if money velocity starts going up, because we know that they're adding cash to the system, if money velocity starts going up, then we could have an issue, because the last time that happened was the late 70s, stagflation. So, everyone's worried about inflation right now. Inflation is still on the table. If money velocity starts increasing, that's something to look out for. Right now, again, it's in the gutter. So, deflation is still on the table, folks. That's why this market environment may be the most difficult that I've certainly ever experienced. There's not a whole lot of great places to put your money right now that seem like a good deal. I will say yesterday, Michael Burry from The Big Short. I don't know if you've seen the movie or read the book. He was played by, I think, Christian Bale in that movie. It was a great flick. I watched it recently. So he was the one that actually figured out all of the subprime issues. Everyone else kind of figured out what he was doing and followed him. The very few people that actually made that play. Yesterday he tweeted out that folks are asking him what's going on with the markets, and his response was that we are in the greatest bubble of all time in all things by 2 orders of magnitude. Now that will get your attention. It certainly got a lot of people's attention yesterday. Now, do I think that we're that bubblicious right now? I don't know. I do expect that we will have a correction at some point. It will be probably bigger than a normal correction. Do I think it's going to be an apocalyptic event? I certainly hope not. I don't think so, but you never know. Like, we're in super, super interesting territory because of this right here. The amount of fiscal and monetary stimulus that's going on right now it's just hard to tell what's, there's kind of some uncharted territory, but at some point you expect fundamentals to reassert themselves and this to come back down out of geosynchronous orbit. All right, so those are the indicators that I wanted to cover today, and we'll wrap things up right here in a second. So when viewed together, these data points indicate a highly overvalued market environment, in my opinion. If we look back through history, markets can remain overvalued for extended periods. So on its face, overvalued markets aren't something to be afraid of. That being said, the current yield of the S&P 500 is lower than the yield of the 10-year Treasury. If stocks' values are supposed to be the present value of their future cash flows, dividends, then what does that tell you about the expected future growth expectations of the stock market? I believe that now is the time for caution. There are two quotes that come to mind for me in this environment. The first is from Warren Buffett, and it's "Be fearful when others are greedy, and greedy only when others are fearful." Given prices, margin levels, and the zeitgeist of meme investments, we seem to be living in a time of extraordinary greed. The second quote comes from J.P. Morgan, and that's, "I made a fortune getting out too soon. As sure as the tides turn, we will have another correction or a bear market at some point. Being early is okay, being late is not. Avoiding the big drop is better than having big returns in any given year. If you drop 50%, you'll need 100% returns the following year just to get back to where you were." Hey, I hope you enjoyed this week's Market Situation Report. If you'd like help protecting your wealth from a potential mean reversion event, then visit us at pranawealth.com to see if we are a good fit. We do still have the capacity to take on new clients. As a fee-only financial advisor in Atlanta, we can and do work virtually with clients all across the U.S., and we're ready to help you whenever you're ready. If you found this video helpful, please help me grow my channel by liking this video and subscribing to my channel. And don't forget, sign up for our newsletter at pranawealth.com/newsletter. Thanks so much for watching, and I'll see you soon.